Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from the wealthyhomeowner.ca, Canada's authority on home ownership. Welcome back to the show, Ross.
And thanks for having me back on, Jim.
Ross, a listener asked if you can explain why the house price index released by the National Bank jumped 4.3% in the first 6 months of 2020, but only 1.7% in the fall of 2019. Have home prices really jumped $117 per day this year?
Oh, my word. Okay, so, it's funny we're talking today because there's this real estate summit that's on supposedly in Toronto, the TO Summit, where all these supposedly experts are talking about the housing market. It's this broker in Toronto has called all these guys to and women to appear on this summit. Some pretty reputable names or people with names that have a high profile, and we're watching the nonsense that's coming out of there. Now, the people aren't talking real estate. That's a different story. Maybe what they're saying is true, but the real estate conversation is just hilarious. And it kind of reflective, I guess, is to this question, because people really do. It's really hard to believe, but people really believe that Canadian home prices have increased $117 a day, in the first 6 months of 2020. Across Canada. Listen to that statement, folks. What they're trying to tell you is, in the first 6 months of this year, home prices have increased more than what the average Canadian brings home after tax in wages each day. That's what they're actually trying to get you to believe. But as increasingly you have to accept, people actually believe this. And how do I explain it? A couple of ways. One, there's two guys. I'm going to use guys just an example. Could be two girls, okay? They go into a Ford dealership to buy a new F-150. They both got $40,000. They walk up into the dealer, and the dealer says, "Hey, what are you looking for?" They both say, "We're looking for an F-150." The dealer says $40,000. Well, for $40,000 right now, F-150s are hot. So I can give you the base model for $40,000. Well, one guy says, "Okay, that's the best I can get for $40,000. I'll buy it." A base model. The other guy says, "Okay, that's what I can get for $40,000. I'll buy it." $40,000. The dealer just had an average selling price in that month of $40,000. That's what the dealer says. The average Ford F-150 sold for $40,000. 2 months later, two new people walk into the dealership, and they look, and they look at the inventory, and they talk to the dealer. Now, the dealer hasn't made any sales in a couple of months, but he's got the same inventory that he had before. It's the exact same inventory. Inventory hasn't gone up. Inventory hasn't gone down. The inventory is exactly the same. These two people say, "Hey, we're looking to buy a new truck." The dealer says, "Okay, well, how much are you looking to spend?" They say $40,000. The dealer says, "Oh, great. Well, that's, my entry-level truck here, the base truck, is $40,000. I can write you up." Well, one buyer says, "Wait a second. How much are those other ones?" And he quotes, "Well, that's the Platinum model over there, and it's $60,000. Let's use an extreme, $60,000. Well, the buyer says, "Well, what's the best price you can give me on that? Because I really don't want to buy that base model." Well, the dealer hasn't made any sales. He's getting some discounts for it. He says, "Well, look, I'll sell you the Platinum over there for $40,000. The other guy standing over the other side, he hears the same thing. He says, "Hey, I want that same deal too. I'll take the Platinum for $40,000. Dealer writes them up, sells them to them. These two guys got Platinum models for $40,000. And the dealer had an average selling price of $40,000. The two guys that bought the base models a couple months ago hear that the average selling price at the dealership for a Ford F-150 is $40,000. They don't understand that the buyers who purchased 2 months ago got a platinum model when they only got the base model. The dealer still has an average selling price of $40,000. Prices supposedly didn't change 1 penny. Well, the average purchase price didn't change, but what you're able to buy for your money radically changed. And this is how house price magic works. What the National Bank actually allows you to do is kind of verify with common sense what I've just explained. Because the way that the National Bank index works is this way. Again, this is something you are not going to hear or see published anywhere else. How National Bank Paranut measures their house price index is this. They report on closing date, houses that were closed in the month. That means the month of June, Paranut's reporting on the houses that closed in June. People often say, hey, well, let's just adjust, because the houses were sold before they closed, let's adjust it 60 to 90 days. And we start laughing at that comment, because that's not how it works. Now, I think I've come to accept why this knowledge is not common. And this is why I think it is, Jim. Because in my case, I sold real estate for decades. I sold thousands of houses. My father, before me, was my mentor. He sold real estate for 10, 12 years before I started. And before him was my great uncle, who was my mentor of my father. So the knowledge was passed down from one family member to another how a housing market works. And then during my period in sales, it was thousands of families that we happened. So this is why I know what Paranut and National Bank was actually reporting on for June prices. What they were reporting on is this. There was first-time buyers that were out looking for a house in November or December of 2019. They saw a house for sale, and they wanted to buy it. The owners of that home, they offered to the owners of that home to buy it with a closing date of March. The owners of that home had kids. They weren't a young first-time buying couple with no kids. They had kids. When they bought this home, they were first-time buyers with no kids, but now they have kids. So they couldn't move out in March because the school year was running till the end of June. So they told the first-time buyers, we'll accept your price, but we can't move out until the end of June when the school year is done. First-time buyers don't care because they're either living in a rental or they're living with their parents. That's the definition of a first-time buyer. They currently don't own a home. They are the buyers with the greatest flexibility in terms of closing dates. And because the seller was willing to accept their price, they said to the seller, okay, we'll close the end of June. Now, of course, these buyers believe that the housing prices are going up at $100, $120 a day. So the only thing they care about was being able to buy the house in December because they figure by June it's going to cost them a lot more money. So we secure a price today and we'll close on at the end of June. We don't care. We're going to live with mom and dad and save more money till June on the down payment. Now, the family who owned the house that those first-time buyers have bought now need to go to find their next home. But they're under no pressure because they don't have a closing date on their own home until end of June. They then plan to, over the next 60 days, to go out and buy their next house somewhere between February and early March, which is going to give them a lot of time to look at all the houses for sale, plus all the houses that come onto the market for the next 2 months. And they can pick the best house for the money that they can find. And they still can offer a closing date of June. They go and find a house, they put an offer in on it, and they tell the owners of that house, hey, we'll buy your house at this price. We need a closing date of June the 31st or June 30th because that's the closing date on our house. The seller says of their house, the house, no problem. We've got to go and find our next house, but that still gives us 60 days to go find our next house. Well, lockdown happened. Uh-oh. There's a whole lot of people in this situation. A whole lot of third-tier buyers. Not first-time buyers, not first trade-up buyers, but second trade-up buyers. They're buying a third-tier home. Well, guess what, folks? Third-tier homes, by nature, are more expensive. They're more expensive in Vancouver. They're more expensive in Calgary. They're more expensive in Toronto. They're more expensive out in Gander, Newfoundland. They're more expensive everywhere. That's why they're third-class homes. The higher the class, the higher the quality of home. More expensive the home is. Those people then went out from once the lockdown was relieved in May, and they purchased their next home, which is why sales increased in June magically. What else happened across the country in June? Housing prices went up. That's exactly what happened. You were, as we discussed earlier, you were going to watch in real time as all the housing myths are debunked. And here's another one. You see, because what Terranet National Bank actually does is they take all the houses in a sales chain, starting, in this case, from December all the way through till May, and they bundle them up as their reported is closed in June. That's why, in the fall of 2019, you only recorded a 1.7% gain in those houses, because the sales chain was more heavily weighted towards the buyers, fewer trade-up buyers. So your house price gain was smaller. It has nothing to do with house prices. It's no different than the Ford trucks. If a home buyer is going to spend $40,000 on a truck and all the dealer will sell him is the base model, he's going to spend $40,000. If the dealer says, hey, I haven't had a sale in a couple months, you can buy the Platinum for $40,000, they're still going to spend $40,000. They're just getting a totally different truck for the same amount of money. This is why Terranet Bank House Price Index, MLS HPI, MLS Benchmark, RPPIs, HPIs across the country, all the economists, every bank, they all measure the exact same amount of change from 2005 till today, with plus or minus 1% over that entire period of time. Because they're not actually ever measuring houses. They're measuring what the buyer is spending. So in this case, you went from a gain in the fall of, from July 1st till December 31st till New Year's Day at the end of 2019. Get my numbers all messed up here, folks. Never been one good with the months, by the way. Always have to get that information for the wife, or my calendars. That 6-month period, house prices were only going at, supposedly, about $20 a day, about $30 a day. Now they're saying they're going up at $120 a day. It's absurd what they're saying. But this is the absurdity of all these house price indexes. This is why the OSFI has repeatedly warned Canadian bankers not to rely on them. You see, the OSFI knows there's something wrong. They just don't know what's wrong. That's because everyone believes house prices went up 4.3%. The banks believe it. The realtors believe it. The home buyers believe it. The home sellers believe it. Economists believe it. Everybody believes it. They believe the world is flat. I believe it's a sales chain that got reported in June the 31st. I would expect that sales chain, when it's all reported, to be measuring the exact same house price change that the average MLS price is. Because I know both of them are measuring how much buyers are spending. They're not measuring how much they're getting for their money. You can be a buyer who spends $40,000 and gets a base model of a Ford F-150, or you can be a buyer who spends $40,000 and gets the F-150, the Platinum model. You get the difference simply by how you time the market. This has got nothing to do with correcting housing market, changing house prices. This is simply changing which month you buy your home in. Because depending on the category of home that you're buying, some months you can buy the Platinum and other months you can buy the base. Wouldn't you rather get a Platinum versus a base model if you're still spending $40,000? I have never met a home buyer, Jim, never met a home buyer since 1987, since the day I started, March of 1987. I have never met a home buyer who said, yes, I want to get less house for my money, Ross. Everybody always says the same thing. I want to get the most house I can for this amount of money. National Bank just proved the switch didn't get switched on in January 1st of 2020, so that house prices now jumped at $120 a day from the $32 a day that they were changed the previous 6 months. This wasn't a switch. It's just the composition of sales changed, and more people were able to purchase Platinum F-150s instead of the base model. That's all that happened. And that's why you get fake house price claims of around $117 to $120 a day.
We'll have more with Ross Kay right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Ross Kay. Ross, much discussion has taken place over home price forecasts. A listener is asking why CMHC, Canada's bankers, the Real Estate Association, and every economist seems to have a different take and a warning on what's going on. What's the real story?
Why are all these people so divergent? Why does one person say housing prices are going to stabilize, remain the same? Housing prices are going to drop 4%. Housing prices are going to go up 4%. Housing prices are going to drop 18%. Housing prices are going to drop 50%. Why do all these people have different answers? They're all supposedly experts. They're all supposedly people who've studied housing markets. Supposedly. I mean, CMHC is a billion-dollar corporation. They have billions of dollars. The Canadian government pays them. Canadian bankers, billions of dollars. Canadian Real Estate Association, they will trade over around $280 billion worth of real estate this year. Multiply that by 4% commission. Come up with your number, folks. Economists, applied, academics from every university in Canada, they all think they've got some comment about a housing market. And why are they all so widely divergent? When we say it's simple to time a housing market and to forecast where housing prices are going to be, that's because house price bubbles all work exactly the same. A house price bubble is fueled by house price inflation. House price inflation is fueled by the continually evolving sales mix, where, as we talked in the last section, the number of base model F-150s being purchased for $40,000 and the number of platinum models F-150s being purchased for $40,000 continually changes month to month, and house price illusion is allowed to react to a result. So what these people are all forecasting is house prices when they're not taking into consideration buyers. The buyer who purchased the base model of Ford F-150 spent $40,000. He spent the base model. If they bought the platinum model for $40,000, they still spent $40,000. CMHC doesn't know what the heck I'm talking about. If you Google house price index, OECD RPPI report, Google it. Because a few years ago, all of the economists in the world got together trying to come up with a new way of measuring house prices. Statistics Canada was involved in it. Every single major country in the world, their top thinkers were involved in this report. It's hundreds of pages long. They couldn't come up with a way of diverting from average selling price. They had a little bit of difference in variations, but everything always resulted the same. So the conclusion they had was, you can use any of these measures. We say, sure, you can use any of these measures because they're not measuring house prices. They never have. A housing bubble forms as a result of people's lack of understanding of how the sales chain works and how supply and demand pressures change at a granular level during a month or 2 month or 3 month period. The quality of house that you're able to buy changes radically. I don't really think when CMHC came out and said housing prices were going to drop 18%, they really understood what they were saying. Because when you're talking about an average, if you have 100 homes sell at $200,000, to get a 50% drop, you have to have 100 homes sell at $100,000. Because the average then, across the year, across all 200 homes, is $150,000. A drop of $50,000. That's what you're talking about here. So if your sales are slower, instead of in the second half of a year, you don't sell 100 homes, you only sell 50 homes. Do the math. What those houses, how low those houses have to sell for to get a $50,000 drop, when 100 homes sold in the first half of the year at $200,000 and only 50 homes sold in the second half of the year. Because now you only have 250 homes sold over the course of a year. How much did those prices of the last group of homes, the last 50 homes that sold, have to drop in order to get the average, just a simple $50,000 reduction? It's staggering. And this is what home buyers are never told, because the home trading infrastructure is built to get sellers the highest price possible. The home trading infrastructure is designed to fund the commissions of realtors' earnings based on the highest price possible. A realtor does the exact same amount of work selling a $200,000 house that they do selling a $100,000 house. But a $200,000 house, they earn twice the commission. The exact same work, but you make twice the money. That's what the home trading infrastructure was built and has evolved to produce. Commission for the realtors. It's why realtors sell on commission in the first place. It's 2020, people. They should be selling on a set fee. Now, if you want to charge a premium because it's a $2 million house, so we want to charge an extra $2,000, so be it. We'll charge you $5,000 to sell your house if it's below $1 million. We'll charge $7,000 if it's above $1 million. Okay, no, they can't do that. They got to do the commission route. Why? Because the skill level required to be proficient in selling services on a dollar basis doesn't exist in the real estate profession. You're talking about 0.02% of all realtors, 2 in 1,000 realtors, maybe if you're lucky, would be able to sell their services that way. So CMHC, Canadian bankers, Canadian Real Estate Association, economists, academics, their forecasts are so widely divergent is because they believe they're measuring house price change when they're not. They're actually measuring how much less buyers are going to be spending. And I'll tell you, Jim, buyers almost never spend less. There are only a few instances that cause buyers to spend less. And those instances are all the same. It's where the government tells them you can only spend less. When the government tells them you are only authorized to spend less, they spend less. And in Canada, that's because we have CMHC. Whatever CMHC says, first-time home buyers and often first-trade home buyers, that's exactly what they do. Whatever CMHC tells them, that's what they do. And we are in a period now of unprecedented limitations on what you're able to spend because of CMHC. So this is what the real question I would have for the listener who asked this question is. Is it possible that CMHC's Evan Siddell understands that if I cut what you're able to spend on a home by 18%, you're going to buy a home that is 18% cheaper, which the Canadian Real Estate Association will then record as an 18% house price decrease, which the Terranet National Bank, when it reports its sales change on a closing at the end of a month, those prices will all mirror that exactly. People will believe what has happened is house prices have dropped 18%, when in fact, what really happened was CMHC said, hey, first-time buyers, you got to buy an 18% cheaper home. And the sales chain all started at an 18% lower price. And each subsequent sale was negatively impacted by that lower 18% purchase on the first place. Is that what's possible? Is that why all these forecasts are so widely divergent? Is that why everyone believes you can't time a housing market? Is that why people are happy buying a basic Ford F-150 while other people are laughing all the way to the bank because they got the platinum model? Housing bubbles are a beautiful thing to watch, but they are financially devastating to those who don't know how they work.
We'll have more with Ross Kay right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, a listener asked, Ross, how much mortgage debt should we be looking to take on when purchasing our first home? I think location plays a big role in this.
Yeah. Did you say first home?
Yes.
So my answer right now is a different answer than I would have given them up until the spring of 2017. Because now the answer that I'm going to give them is the same answer I would have given them from the day I started selling real estate till I quit selling real estate up until the spring of 2017. And that's this. Whatever CMHC tells you right now, as of today, spend it. Spend it all. If they tell you you can afford, you're approved for a mortgage of $300,000, spend it all. I'll tell you, I never would have given you that advice before the spring of 2017. I never would have given you that answer. I can give you that answer now because the way that the numbers are calculated. Because CMHC has so dramatically changed the home buying landscape, yet it has gone unreported across this country now for 3 years. You right now, as a first-time buyer, any first-time buyer listening to me right now, you go right ahead and borrow. Get as big a mortgage as CMHC will allow you to get. If CMHC is going to insure your mortgage, go ahead. Take as much money as the bank is going to lend you because you are so safe right now. You are purchasing a house the same way the thousands of home buyers that my family sold homes to over 5 decades bought their home. We never, ever sold homes the way that the rest of the real estate industry did, okay? We never pushed people to the gross debt service maximums that were allowed by CMHC because we knew how dangerous it was. We knew how that it would take you, at least in the early days when I first started selling, it was going to take you 8 years before you reached a safety zone in your ownership profile. Today, the way CMHC lends money, you're in a no-risk zone the moment you move into your house. The only risk you really have is, are you going to lose your job? And that discussion should be no different today than it has been for the last 50 years. Because if you lose your job, you know what your income is going to be from unemployment insurance or from whatever other sources that you're going to get money from. Family, transfer, government transfers, whatever the case is. You know what your worst case monthly income is going to be. What I'll tell you is, as long as you have unemployment insurance, based on the lending criteria now that is in place with CMHC, you have no risk of losing your home until unemployment runs out. Now, if we have an economy where your unemployment runs out and there's no jobs, it means the country is in a depression. And that means losing your home means you're going to walk away from your home. And under those circumstances, if those circumstances were to ever take place, it's something you really don't need to worry about because it is something you can't plan for. You can protect your family, protect your home buying decision by up to 90%. But that last 10%, you're never, you know, the circumstances, a meteor could hit, in Alberta and it could cause, you know, a blackouts across the nation, for a year to wipe out our electrical grid for the sake of the argument. Okay? Those sort of things could happen. A pandemic can arrive. Lock down your nation. A vaccine for the pandemic isn't found in a short period of time is what it looks like scientists are now saying is going to take place. Okay, so now we're a year from now. It gets worse. Or the next pandemic comes. And, you know, this one impacts children, not the elderly. Okay, our society is going to react to that totally differently. If it's children impacted, believe me, you're not going to see anybody out at a bar this weekend. If it's children we have to worry about, believe me, you're not going to talk about anybody not wearing a mask, or you're not going to talk about anybody not breathing on somebody else, or you're not going to talk about social distancing, or you're not going to be talking about our own personal freedom. If it's a child that we're worried about, those circumstances are out of your hands. Don't worry about it. What's going to happen is going to happen. But what I'll tell you this, if you have job security and you're going to buy a home, I'm going to tell you not to buy it, right? I mean, obviously that's the first thing I'm going to tell you. Don't be foolish enough to buy a house right now. We just went through the period where pent-up sales, trade-up sales, and the third class of sales, third class of trade-up sales had to take place. That's why you had all these house price jumps. That's why you've got all these guys, all these experts around saying, oh yeah, the housing market is, yeah, right. Show me the sales mix, guys. You do whatever CMHC or Genworth approves you to do. If they approve you to take a $300,000, if they approve you to take a $500,000 mortgage, take it, people, because it is consuming such a small share of your income that no other first-time buyers in the last 50 years have purchased homes with this low of a share of their income going towards their mortgage. The OSFI stepped in and realized the unethical nature of Canadian banks, Canadian realtors, and Canadian mortgage brokers. They realized how unethical all of those people were because those people were overselling mortgage debt to Canadians. The OSFI was clueless to it too, folks, until, for whatever reason, they gained the information that gave them some insight. And they said, oh, yeah, it was safe lending people at 34% gross debt service ratio when interest rates are at 11%, but it's extremely risky doing it when those mortgage interest rates are at 4%. Oh, we didn't know how risky it was. Well, here's the number, folks. This is how home ownership math works. The OSFI stepped in and said, whoa, no. You can't borrow that much money anymore. You gotta borrow less. You can borrow so little right now as a first-time buyer that you have virtually zero risk of having, other than a depression, not being able to find some way of making your mortgage payment and still living an enjoyable life. You don't have to budget for health care because in Canada, we have a taxpayer-funded health care system. In other words, if you get laid off, you don't have to worry about where your health insurance is going to be paid from because Canada is going to pay it for you. The only thing you have to worry about is making your mortgage payment, your property taxes, and groceries. Everything else you can get by on. The OSFI has ensured you no longer have to worry because if you get a CMHC insured loan, the OSFI is assuring you, and I personally am too, you can borrow as much money as they'll give you because you have no risk.
Ross, thank you so much for chatting with us.
Thanks for having me on, Jim.
Our guest has been Ross Kay, home ownership consultant at thewealthyhomeowner.ca. If you have any questions for Ross or any of our other guests, you can send them to info@housestreet.com. Find us on Twitter @HouseStreet, our YouTube channel, Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.